There's a lot of themes to contend with right now, Alex. Where are you at? Has this divergence between equities performance and sentiment and what we see in rates markets gone a little bit too far?
I don't think we're at the point yet where we can say it's gone a little too far. I think some of the moves, though, are somewhat puzzling. It does appear that, as you're seeing the bond sell-off, that some of the bond sell-off is allocating to equities. But to see some of the correlations that we're seeing, it is a bit puzzling at the moment, especially what we're seeing in terms of the market pricing in stagflation risks and the market pricing in a broadly weaker growth outlook. So it's hard to say it's gone necessarily too far yet, because we're still waiting for more details in terms of what is the actual impact of the Ukraine crisis on inflation sustainably. And so far, the data has been mixed as well. Some of the data coming out of the U.S., particularly consumption data, has still shown some strength. So we're still expecting economic growth to remain relatively strong.
What are your picks then, if there are concerns about stagflation, if there are concerns about with more aggressive and coordinated policy that we're going to see the next set of recessionary conditions being pulled forward, do you have any ideal hedges within the repositioning at this point?
Yes. So with this backdrop, given how highly unusual it is, if you are looking at moving towards the end of the cycle, normal late cycle type positioning doesn't necessarily work when you're facing somewhat of a stagflationary backdrop, when you're seeing bonds sell off and yields continue to rise. So we are looking at specific areas that can provide either a hedge against inflation. Within equities, we've become much more selective, and so within equities, looking at adding defense sector, just given what we're seeing with an increase in defense spending, commodity-linked equities, given that they add a hedge if we see commodities rise further. We are also looking at adding more commodities and broad real assets, given that they provide a hedge, at least historically have provided a hedge when you see periods of high inflation. And broadly within equities, from an asset allocation perspective, moving more defensively as we are approaching the end of the cycle.
So, when you look at stocks right now, I think you can even say this broadly. Many people say, where are you going to put your money if you don't put it in stocks? I guess you could buy commodities, but you might, and commodity companies. But when you look at the other alternatives, people say that's going to continue to be one of the big forces supporting stock markets this year.
Yeah, it's a difficult mix for asset allocation, because certainly you don't want to go to cash with inflation at what it is and cash rates where they are. And so it doesn't leave too many other alternatives where bonds are not also providing the same downside protection you would normally get as you approach end cycle, as you see recession probabilities rise. And so that does still leave stocks as the next best option. But what we're looking at is just being much more selective. So higher quality companies with healthy balance sheets, still growing, positive cash flows. So being more selective, and also just focusing on client portfolios and making sure that they're well diversified. Because at the end of the day, that's also your best friend as you approach periods of heightened uncertainty.
So, Alex, then is there a country in Asia, an industry in Asia that you would say we're going to be most likely to find those kinds of companies?
Well, at the moment, we're still liking onshore China. Aspects of tech, say semiconductors, we do like as well. We're still seeing quite strong semiconductor demand. That is helping, if you look at data in Taiwan or data in Korea in terms of tech exports, in terms of industrial production, that's still looking relatively healthy. And then onshore China, where you just see the cycle at a much different part than the global cycle in terms of the Fed hiking and the PBOC on an easing path. So you can look at China, but still more selectively as well. So that areas that have some of the fiscal tailwinds, and as well, just given where we are from the commodity price perspective, some of the SOEs in China, whether it's in the materials sector or it's in the energy sector, also provide somewhat of a buffer with high energy, with high commodity prices. So, so still onshore China, and then some of the semiconductor exposure in Korea and Taiwan.